Wealth buys a rental property. Alicia puts the same money into index funds. They both think they made the smarter choice. 20 years later, one of them is genuinely wealthy. The other one is also genuinely wealthy. But then, one spent 2 decades dealing with tenants, repairs, vacancies, and unexpected expenses, while the other spent 2 decades doing almost nothing. Guess the surprising part? They ended up with almost the same amount of money. So which investment actually won? The answer is not what either side wants to hear. Here is the problem with every real estate versus stocks debate video you've watched. Someone always picks a winner before they even run the numbers. The real estate guy says cash flow is king. The index fund person says compounding is everything. Neither of them is lying, but both of them leave out the parts that make their side look bad. This video isn't going to pick a winner. We're going to look at every number honestly, the ones people put on thumbnails and the ones they hide in the fine print. By the end, you'll know which investment actually came out ahead, why the answer is more complicated than either side admits, and what it means for you. Before we get into the numbers, if you find this kind of honest breakdown useful and want more videos like this, subscribing helps a lot. Now let's get into it. Wealth and Alicia both have $50,000 saved. They're both popular finance creators, and their audiences couldn't disagree more about how wealth should be built. One side swears real estate is the answer. The other says index funds beat everything. For this comparison, we're putting both opinions aside. Same age, same city, same income, same starting point. The only difference is what they do with that 50 grand. Wealth uses it as a 20% down payment on a $250,000 rental property. A solid, decent 3-bedroom house in a good neighborhood. He gets a 30-year mortgage at 7% interest. His monthly payment is about $1,330. He finds a tenant who pays $1,800 a month. On paper, that's $470 a month in profit before any other costs. Wealth feels like a genius, he tells his friends. He drives past the property on the way to work and thinks, I own that. Alicia takes the same $50,000 and puts it into a total stock market index fund. No tenants, no keys, no story to tell at dinner. She sets up an automatic $300 monthly deposit directly from her paycheck, hits confirm, and closes her computer. When her coworkers ask her during lunch what she's investing in, she says, index funds. They nod and change the subject. Nobody's impressed. On day one, Wealth has a physical property. Alicia just has a brokerage account and an email confirming the deposit. That's it. This is the first thing the real estate versus stocks debate almost never talks about. The psychological experience of these two investments could not be more different. Wealth's investment is visible, tangible, and socially impressive. Alicia's investment is invisible, abstract, and boring. That difference in how it feels will influence every financial decision both of them make over the next 20 years. And feelings, as we will see, are expensive. For the first year and a half, Wealth is living the perfect landlord dream. Every single month, right on the first, the rent check clears into his account. When tax season comes around, he uses mortgage interest and property depreciation to lower his tax bill. Every mortgage payment he makes slowly lowers his loan balance, building his equity. On top of that, home values in the neighborhood are creeping up. Everything about this investment feels real, solid, and smart. It is working exactly like he thought it would. Meanwhile, Alicia logs into her brokerage account maybe once every few months. Year 1. Her $50,000 has grown to roughly $55,000. Year 2, the market dips a bit, then goes back up to $61,000. To her, it doesn't feel like anything is actually happening. There is no key in her pocket, no tenant texting her updates, and no property she can look at from her car window. It is just numbers on a screen that go up a little, down a little, and up a little more. Now, let's run the actual numbers through year 3, because this is exactly where the dream of easy real estate runs directly into real-world expenses. Wealth has collected roughly $64,800 in rent. His mortgage payments total about $47,880. That leaves $16,920 in gross cash flow. Things are going smoothly, but then he starts subtracting everything that never shows up in the YouTube thumbnails. Property taxes cost roughly $3,000 a year. Insurance adds another $1,500. A water heater replacement costs $1,200. A roof leak costs $2,800. 1 month of vacancy wipes out $1,800 in rent and another $600 in cleaning and relisting expenses. To save money, Wealth manages the property himself, which means late night phone calls, weekend showings, and coordinating repairs during his lunch breaks. Suddenly, that impressive looking $16,920 starts shrinking very quickly. After all the real costs are accounted for, Wealth's actual net cash flow over 3 years is somewhere between $2,000 and $4,000. Not the $16,920 that looks so good on a napkin, and that still doesn't account for a single hour of his time. Meanwhile, on the other hand, Alicia has put in $50,000 plus $10,800 in monthly contributions over those same 3 years. At roughly 10% average annual return, the historical average for total market index funds, her portfolio is sitting at approximately $76,000. 0 hours managing it, 0 phone calls, 0 emergencies. But here is what Alicia does not have that Wealth does. Leverage. Wealth used $50,000 to control a $250,000 asset. After 3 years of appreciation at 3 to 4% annually, that property is now worth roughly $270,000 to $280,000. His equity has grown to approximately $55,000 to $65,000. That's real wealth. And it came partly from using the bank's money. That's the power of leverage, and it's the one advantage stock investors can't easily replicate. The rent check is the number everyone talks about. That is actual wealth, and a large part of it was created by using the bank's capital. That 5-to-1 leverage is the biggest advantage real estate has compared to stocks, and it is exactly why this debate is never as straightforward as people make it seem. Let's talk about the real estate expenses that almost never appear in the simple calculations. Vacancy. The average rental property can sit empty for around a month every year. That means you are still responsible for the mortgage while collecting absolutely nothing. Every time a tenant moves out, you are covering repairs, cleaning, advertising costs, and the time it takes to find someone new, maintenance, and repairs. A realistic estimate is around 1 to 2% of the property's value every year. On a $250,000 property, that means roughly $2,500 to $5,000 annually. Some years, it is a small $150 repair. Other years, it is a $6,000 air conditioning replacement that cannot wait because it is the middle of summer and your tenant is already complaining. Capital expenses. Roofs usually last around 20 to 25 years. Furnaces around 15 to 20. Water heaters around 10 to 12. These are not random surprises. They are future expenses waiting to happen, often costing between $5,000 and $15,000 at once. If you are not saving monthly for these replacements, you are not managing an investment. You are hoping nothing breaks, and hope eventually sends you a bill. Property management. If Wealth decides to hire someone, he is immediately losing around 8 to 10% of his rental income. That could easily be $150 to $180 every month. If he manages everything himself, then he is basically taking on a second job without adding a salary. Bad tenants. A tenant who stops paying and understands how to delay the eviction process can create months of lost income, plus attorney and court costs. One bad situation can wipe out an entire year of gains. It happens even to experienced landlords. None of these expenses show up in the original $470 monthly cash flow calculation, but every single one of them shows up in the real bank account. 5 years later, Wealth has experienced what owning rental property is actually like. He is now on his third tenant. He replaced the roof for $8,500, paid $1,400 for an emergency plumbing issue, and dealt with a month of vacancy. His true cash-on-cash return after all expenses is sitting closer to 3 to 5%. Still a decent return, but nowhere near the 15 to 20% he originally told his friends. Alicia, on the other hand, is basically doing nothing. Her portfolio has grown to around $135,000 to $150,000 by year 7, including her ongoing $300 monthly investments. She never tried to pick the next winning stock. She never jumped in and out of the market. She simply stayed invested. And now the power of compounding is starting to show. The growth from her previous gains is creating more new money every year than the amount she originally put in. By year 10, Wealth's property has increased in value to approximately $335,000 to $350,000. His remaining mortgage balance sits at around $166,000 to V. That leaves him with roughly $170,000 to $184,000 in equity. His total money invested beyond the initial down payment over those 10 years comes out to around $20,000 to $40,000. Alicia's portfolio, with her consistent $300 monthly contributions, has grown to approximately $165,000 to $180,000. She contributed about $86,000 in total. Everything else came from the power of compounding. No weekends spent repairing problems. No calls from tenants. No unexpected maintenance bills. By year 20, Wealth's property has grown to around $450,000 to $500,000 in value. His mortgage is either completely paid off or very close to the finish line. His total equity is now somewhere between $400,000 and $500,000. But after 20 years of dealing with maintenance, repairs, tenant problems, taxes, and insurance, his actual profit from rental cash flow beyond his expenses is only around $50,000 to $90,000. Alicia's portfolio, assuming a 10% average yearly return with the same $300 monthly contributions, has grown to roughly $420,000 to $460,000. Her total contributions over 2 decades equal about $122,000. Everything beyond that more than $300,000 came from compound growth. No debt, no tenants, no late-night calls about a leaking pipe. At year 20, both of them end up in a similar range, somewhere around $400,000 to $500,000 each. But each journey was completely different. Wealth had to actively manage his wealth. Alicia simply gave her money time. Now, here is the part that changes the math more than anything else. If Alicia increased her monthly contribution by just $200, bringing it from $300 to $500 per month, her 2-0-year portfolio jumps to roughly $550,000 to $600,000. In the stock market, increasing your contribution has a multiplied effect through compounding. A relatively small increase today can create a surprisingly large difference decades later because every additional dollar gets the benefit of time. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and adding another layer of responsibility. That does not make one strategy better than the other, but it does highlight how differently they scale over time. Now, let's be equally honest about the index fund side, because if this video only covered the downsides of real estate, it would be making the exact same mistake that many stock market influencers make. Volatility is real, and it can be brutal. In 2008, the total market dropped roughly 37%. In March 2020, it fell more than 30% in a matter of weeks. During the market crash, Alicia opened her account and saw years of gains disappear in weeks. Her $150,000 invested became $95,000 almost overnight. That is not just a number on a screen. That is emotionally difficult. And the data consistently shows that many investors panic during market crashes, sell at the wrong time, and buy back in after the recovery has already begun. The strategy works exceptionally well if you stay invested through everything. The problem is that many people do not stay invested through everything. There is also no meaningful cash flow for most investors. Index funds do not send monthly rent checks. They produce long-term growth, but for someone trying to generate immediate income, that growth can feel invisible. There is also no leverage. Alicia used $50,000 to control $50,000 worth of assets. Wealth used $50,000 to control a $250,000 property. That 5 to 1 leverage is one of the primary reasons real estate has created extraordinary wealth for so many investors over the last several decades. And unlike stock investors, real estate owners also have access to benefits like depreciation, which can reduce taxable income even while the underlying property appreciates in value. So, after all the numbers, all the projections, all the arguments, and all the assumptions, who actually won? Was it wealth? Was it Alicia? The honest answer is that both of them succeeded. Wealth built substantial wealth through leverage, cash flow, and property appreciation. Alicia built substantial wealth through diversification, simplicity, and the relentless power of compounding. Neither one found a secret shortcut. Neither one discovered a magical investment that guaranteed success. They simply followed different paths to a very similar destination. But here is the part that most real estate versus stock market debates completely miss. Wealth spent 20 years defending real estate. Alicia spent 20 years defending index funds. Meanwhile, the person who quietly bought a good rental property and consistently invested in index funds every month probably ended up ahead of both of them. That person was never focused on winning an argument. They were focused on building wealth. And that changes the entire conversation, because the real lesson is not that real estate always wins. It is not that index funds always win. It is that wealth is rarely built by finding the perfect investment. More often, it is built by combining multiple good investments, avoiding obvious mistakes, and staying consistent for a very long time. The biggest gains often come from stacking good decisions together, not from spending years arguing about which single strategy is superior. So, the next time someone tells you that real estate always wins, or that the stock market always wins, ask them one simple question. Did you include everything? Did you include the time, the stress, the leverage, the risk, the opportunity cost, the taxes, the volatility, and the human behavior behind the numbers? Because the answer that includes everything is the only answer that actually matters. If this video gave you a clearer picture of how these two investments really compare, not the thumbnail version, but the complete version, make sure to like the video and subscribe for more breakdowns that look beyond the headlines and focus on the math that actually matters. And let me know in the comments. Are you team real estate, team stocks, or do you think the real answer is doing both? I read every comment, and I would love to hear your perspective. See you in the next one.